We have witnessed an acceleration of the trends previously seen in 2017, month after month of gains. Indicators were flashing red, warning signs everywhere, but 2020 is truly different. Different in that there is basically nobody suggesting that the market will go down at this point. The Fed has acknowledged their desire to create confetti currency and the people love it. But do they even know what they're wishing for? You came here for the truth, so let me unveil that for you. Stocks are easy money. I keep seeing this all the time. There are people in the comments, there are people out in the industry, and there are so many with the shoe shine boy and the barber telling you the same thing. This mantra that stocks are easy money has persisted for quite some time. And obviously, with the Federal Reserve being behind this all, you know specifically where this has gone. They have every reason to believe this because, of course, their knowledge doesn't go any further back than a few years ago. If there's one thing though we know about gambling, it's that specifically with poker, if you're trying to convince your other players at the table that you mean business, you have to go all in. You're never going to be able to convince anybody in your level of conviction unless you go all in. And that's why I think more people should not only take their entire house, sell it, get the money, put it all down, leverage those positions as much as they possibly can. They should go and find the place to sell their kidneys. Why not both? Just do both. You'll be able to get brand new ones when you make all that money back, right? Do anything you can because you're so sure that this is going to be a guaranteed win, right? I mean, if you knew 100% this was a guaranteed win, why wouldn't you do all those things? And I know I'm being silly here, but this is the mentality. If you really had conviction, if you really had this belief in you, then you would go all the way. Do you? Right now in 2020, millions are part of the working poor and they're being pushed to the edge. In just the past 6 months, more than 22 million American jobs have been lost and fewer than half have so far returned. Even when they're working, many people weren't earning enough to get by. This is an issue that we have talked about extensively and it will not show up in the statistics. They give us the fake U3 unemployment rate, you know the deal with that. But ultimately, so many people are not even able to make it into these statistics, and yet they can't afford their food, they can't afford their shelter, and the number of people that are in this group continues to grow. And instead of bringing our attention to that obvious fact, to that terrible fact that so many people are struggling, we focus on what the Federal Reserve is doing and what they can do for us. BlackRock leads investors worldwide with follow the Fed mantra. I had brought this up initially, this article is from back in April, essentially suggesting that BlackRock is simply going to do whatever the Federal Reserve does. If they buy these ETFs, they're going to buy the ETFs. If they buy the corporate bonds, they are going to buy the corporate bonds. And they are just playing this silly game and they are profiting from it. They are going to know when the time is to sell because they're buddies, because they are doing one and the same thing. You as the individual might be buying and buying in, and suddenly you don't realize that this is that Wile E. Coyote moment. They've stopped buying a while ago, and now all you're doing is looking down off the cliff. But nobody ever thinks of an exit strategy, which is the absolute most important thing for any investment. When you buy, you should already have your exit strategy in place. That goes for the paper assets, that goes for real estate, that goes for anything else. Throughout this period of time, we have seen the market acting in one way and the economy going another. This right here just shows you our US cycle indicator is improving. I had shown you this previously. It's from Morgan Stanley, and specifically want to note something. This red area here, if you remember, for those who had watched, I had shown you when this started to appear as a red line, and that is, if you look at the legend down here, downturn. That actually did signal correctly. So it is quite interesting to see how this comes to be. Right now, it's on the way up, but it might be hard to see now that I just covered over it. It has kind of tapered off. So this is interesting because that goes in with some other statistics that we have witnessed where they kind of started to turn around. They did this pattern, as they like to call the V shape, but as you know, it's much worse than that. But now it has started to come around and look not so good. But there are some statistics that have come up from where they were, definitely have started to recover, have started to move in that direction again. I wanted to bring this to you because it shows you the difference between what we're seeing in the stock market, what we're seeing in the economy. For many stocks, they have simply skyrocketed. The economy, not so much. You can take a look at the top few stocks, those 5 stocks, 10 stocks, the tech stocks that have really, really done very well. And it's a complete different picture than what I talked about at the beginning of this video. I'm going to show you some of those exaggerated factors today. The fundamentals of high growth stocks are ugly at extremes. And what we're looking at here, the different rows, the dot-com peak, what we have today, as well as the historical average. And you can go through and see the PE ratios and look at the different growth and other ratios that they've gotten here, but essentially just want to note the fact that we are looking in many cases to be at the same factors, the same ratios that we saw back in the dot-com peak. It is truly abnormal, it is historic, but you have to be specific about what's happening because it is only a handful of stocks that have moved up, and I believe I have some data on that in just a second. Many of the rest have lagged behind. All the interest is in a few, and that is never a good thing. It is quite dangerous. Current growth firms are as expensive as August 31st, 99, right before their batting average imploded. And it's just comparing here, as you can see, looking at today and August 31st, 99, 23 times, and it in a short period of time, in fact, 1 year, it became 90x. So when you look at the difference between these two, it's excessive, but on the timeline, not that much. On top of that, however, we have many, many more problems than we did in the year 2000. There's no doubt about it. The debt, the deficits, the economy is much weaker. The 90s were largely fantastic in so many different ways for the economy, for the markets. It was much more sound. Interest rates, while they were low compared to the 80s, they were still much higher than where they were all throughout this period after the financial crisis. So it's a completely different world today, and that is not a good sign for what's coming. Total credit to non-financial corporations. The credit bubble continues to grow. My goodness, the amount of debt. We have to look at corporate debt and never forget about it because this is one that nobody wants to touch, and yet it's so important. In this case here, they're measuring it as a percentage of the GDP, but it is ugly no matter how you look at it. Path to the top 5. Apple, Microsoft, Amazon, Google, Facebook. It shows you when they entered the index, which is quite interesting because you can look at Apple 1982, Microsoft 94, and so on, go down the list, and looking at where they are today. Market cap rank in the S&P 500, right now, Apple is number 1. Back in 2008, it was number 11. Things have really changed, there's no doubt about it. That top 5 looks very different than it did 15 years ago and more. The 5 largest stocks in March 2000. And then if you go midway down, it starts the 5 largest stocks today. So let's take a look at this because if you see at the top, Microsoft is right here. And then we go down, Cisco, General Electric, Intel, and ExxonMobil. ExxonMobil was booted out of the index, never mind being in the top 5. Look at the 5 largest stocks today. Microsoft, Apple, Amazon, Alphabet, and Facebook. Now, of course, things do change over time. You're not going to expect the fact that one company is going to be the top forever. And that's what we get this nonsense. You need to hold for the long term. Well, how long? How long do you want to be able to hold onto a stock for? Because not a lot of companies are able to maintain a certain status over several decades. In fact, that cycle is probably going to continue to get shorter and shorter and shorter as new fads come in and out. There's a lot less brand loyalty today than there was, let's say, 50 years ago or more. So be aware of that when you are investing, when you are looking into things to buy. You have to have your exit strategy in place. Chart on the left-hand side, market leadership is difficult to maintain. You can see the 5 largest stocks in 2000, that's the darker blue line. And over the years, they have started to fade away from their dominance. And on the other end of the spectrum, we are seeing the top 5 today accelerating to new heights. On the right-hand side, on average, 5% of the S&P 500 turns over each year. On average, 5% of the S&P 500 turns over each year. There's a huge spike up as you see in the year 2000, but this is always in flux. Performance of rule of 10 stocks. Rule of 10 companies excludes the FANG stocks, or in this case, Facebook, Apple, Amazon, Microsoft, and Google. We're essentially looking at the tech stocks, right? This is the index year-to-date return, and I'm just comparing right here what we're looking at with those tech stocks, how well they have done. You can look at the breakdown that they have, but I just want to show you the fact that, yes, we did have this fallout took place. Everything basically moved down for this period of time. My goodness, oil was trading in the negative in many instances. And then we had a resurgence, specifically with those tech stocks. They came up quite a bit. But you look at the equal weighted S&P 500, minus 4%. Just to give you some perspective of what's been happening today. You know that I've talked about this at length, and this is the commercial mortgage-backed securities. Just covered it yesterday. Number one, I wanted to acknowledge somebody said that the article that I was looking at was from 2019. I do believe that is accurate. However, if you see right here, this issue is coming up. It's resurfacing now. That's why I had brought it up. This is September 18th, 2020. A $700 million CMBS portfolio is on the brink as malls collapse. Exactly what I was saying yesterday. I'm not going to go into it any further. Just wanted to acknowledge that's not old news. The problem is here and now. The second part is that I saw somebody say, you're always saying that this is happening, blah, blah, blah. But this is specifically what I've been warning about. It's the commercial mortgage-backed securities, the derivatives, and how it isn't the residential side that we need to be worried about right away. It's the commercial side. I told the person that they did not watch the video, and they did reply saying they don't watch the videos, but I guess commenting on videos they don't watch is a pastime. Very, very unusual. Billionaire Ron Perelman selling almost everything as 2020 roils his empire. All I'm trying to highlight here is that there are people that have amassed this huge amount of wealth over years, over decades. They've made correct decisions, they've made mistakes, but ultimately they've been able to accumulate more and more. But it can change so fast. I think in this article they quoted, he went from something like, let's say, 18 billion down to 4 billion. Imagine that in a year, not even a year at this point. It shows you the significance and the speed at which things can change. I believe it was yesterday's video where I told you that they were selling flights to nowhere. I said that this business model probably wouldn't work out, and I want to highlight here that I was wrong. I was completely wrong. Qantas 7-hour flight to nowhere sells out in 10 minutes. I couldn't believe it. A 7-hour flight, in my opinion, the worst part of travel being on the airplane, and people are doing that. Not only that, it's sold out in 10 minutes. I was just very surprised. I thought I would bring that to you. A little humor. You tell me, would you take a 7-hour flight to nowhere? That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. Simply by clicking one button, you help me out. Thank you very much. Do you want to understand e-commerce? I'm talking about every single step of the way. I get emails from people occasionally telling me how they really enjoyed the course, how they learned a lot. Whether they took action or not, I'm not sure, but I'm doing what I can, doing my part, and I'm providing it for free. So please take advantage while I can do this. I actually put money into it in order to keep it operational. TheAmazonGPS.com. Have you seen my 2 books? I talk about everything there is with the financial system. I talk about the 4 asset classes. I talk about how to make money. You can see this in the description. Check out the link. If you want the audiobook instead, you can get that at themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? So much information jam-packed. You definitely want to check it out. Click it. I'll see you there.